Welcome to Iron Financial, the place where we help you forge a stronger portfolio by cutting right through all the market weakness. Today, we're putting Omeros, that's ticker OMERR, under the microscope. And let me tell you, this is a perfect example of why you can never, and I mean ever, trust a headline number at face value. Because what looks like a brand new skyscraper from a distance can sometimes be built on a foundation of nothing but sand. So today, we're going to put on our hard hats and we're going to stress test the very structure of this company to see if it can actually handle the pressure.
Okay, let's just get right into it. It all started with this one number, $3.14. That's the earnings per share, or EPS, that Omeros reported for its fourth quarter. Now, for a small biotech company, a number like this, it's an absolute bombshell. Seriously, this is the kind of figure that sets trading algorithms on fire and has retail traders piling in, thinking they've just found the next rocket ship to the moon.
Whoa, hold on a second. Let's put that number into some real context here. The market, the so-called smart money, was expecting them to lose 52 cents a share. Instead, they come out and post a profit of over $3. That's a 700% earnings beat. I mean, come on, I've been doing this for a long time, and a surprise that big is almost always some kind of illusion. So is this real, sustainable growth we're looking at, or is it just some clever financial engineering? Are we witnessing a genuine corporate turnaround, or is this all just smoke and mirrors designed to pump up the stock price?
And that is the billion-dollar question, isn't it? It's the whole mystery we're here to unpack today. Where did this mountain of cash just suddenly appear from? Because the answer to that question tells you everything you need to know. Did Omeros just pour a solid steel-reinforced foundation for its future? Or did they just sell the copper wiring out of the walls to keep the lights on for one more quarter? We are drilling past that shiny headline to inspect the very structure of this company.
So, all right, let's start with the story that most people saw, the one that flashed across their screens. Omeros reports this absolutely massive earnings surprise. And what happens? The stock jumps over 2% in after-hours trading. Press releases start flying, the headlines hit all the news wires, and from a distance, it looks like a colossal victory. You'd think a struggling little biotech company had finally turned the corner and is now just wildly profitable. But here at Iron Financial, we know that headline is just the beginning of the investigation. It's never the end.
To get to the real truth, you have to do what 99% of investors just won't do. You have to completely ignore the bottom line for a minute, that flashy, attractive EPS number. And you have to focus on the top line. You have to look at revenue. Revenue is where a company's real, fundamental strength is. It's the load-bearing wall of the entire corporate structure. You see, profit can be manipulated, it can be twisted with accounting tricks and one-time events, but revenue from your core operations, that tells you if customers are actually buying what you're selling.
And here it is. This might be the single most important number in the entire Omeros earnings report. 0. That's right, a big, round 0. The company that just posted a 700% earnings beat sold absolutely nothing. The factory was dark, no products went out the door, the cash register was completely empty.
All right, stop the tape right there. Are you telling me they booked a profit of $86.5 million on zero revenue? How is that even remotely possible? Are we building this skyscraper out of thin air? I mean, profit without sales, that literally defies the basic laws of business. What is this foundation actually made of? It feels like we're on shaky ground here.
Exactly. It's because the profit was completely and totally disconnected from the actual day-to-day business of the company. This wasn't recurring income, it's not sustainable, and it certainly was not a sign of operational strength. No, this was a one-time cash injection that came from selling off a major asset. Think of it less like a profitable quarter and more like a homeowner selling off their spare lot to a developer just so they can pay the mortgage. It's a temporary fix, It's not a long-term business model. And here are the nuts and bolts of that deal. Omeros sold the rights to one of their drugs in the pipeline, a drug called Zaltenibart, to the pharmaceutical giant Novo Nordisk. In return, they got a massive $240 million in cash right up front. That is what drove the entire earnings beat. But listen, it wasn't just the upfront cash. The deal is structured with up to $2.1 billion in potential future payments based on hitting certain milestones, plus tiered royalties on every future sale. So they didn't just sell an asset. You could argue they secured a potential long-term financial lifeline.
Right. And of course, the CEO, Gregory Demopoulos, he comes out and frames this as a significant inflection point. It's his job to spin it that way. But the real question for us as investors is, what kind of inflection is it really? Is this the moment they pivot to a genuine position of strength?
Or is this a desperate move? Are they selling off the crown jewels just to keep the castle from crumbling down? Let's be honest, a healthy, growing company is usually buying assets, not selling off its most promising future revenue streams. It really makes you question the health of their core business.
And that question brings us to the absolute core of the bull thesis. The argument from the other side is that this deal wasn't about survival at all. No, it was a strategic masterstroke. It was designed to fund the company's new cornerstone project, the commercial launch of their brand new FDA-approved drug, YARTEMLEA. The idea is they sold one potential future in order to build an even bigger one. This cash infusion isn't for paying down debt or covering salaries. It's the raw material, the concrete and the steel, needed to construct an entirely new revenue-generating pillar for the company.
So what exactly is YARTEMLEA? Well, the scientific name is narsoplimab, but in business terms, it's a potential gold mine. It is the first and only FDA-approved drug for treating a rare but often fatal complication of stem cell transplants called TA-TMA. This is what Wall Street gets excited about. They call it a classic unmet medical need. And when you are the only approved game in town for a deadly condition, you have immense pricing power and a captive audience. This is the bedrock on which they plan to build their entire future.
$36,000 per vial. And the company itself says that the median use is somewhere between 8 and 10 vials for a course of treatment. Go ahead, do the math. We are talking about a cost of roughly $300,000 per patient. That is a staggering number. And it immediately raises the single biggest question for a drug like this. Who is going to pay for it? Look, having an FDA-approved drug is one thing, but getting insurance companies and hospital systems to actually write the check and reimburse you for it, that's a completely different war. A high price tag like that can be a major crack in your market access strategy right from the start.
And this slide shows you exactly why that $240 million was so absolutely critical. A commercial drug launch is an incredibly expensive, heavy lifting operation. Getting that FDA approval, that's just step one. After that, you have to build out a supply chain, which, to their credit, they've done. But then the real ground war begins. You need a massive sales force to go out and educate physicians. You need a whole team of specialists to negotiate with every single insurance company and hospital network to secure reimbursement. This is an expensive, multi-year process. That Novo deal provides the fuel for this entire engine. Without it, they'd almost certainly have to dilute shareholders to raise the cash needed to get this off the ground.
So, with all that cash secured and the new drug approved, let's take a closer look at the financial blueprint that management has laid out. How exactly do they plan to construct a profitable company on top of this new foundation? Because this isn't just about a single product launch. It's about a multi-year strategy to transition from a cash-burning research company into a self-sustaining commercial enterprise. Let's see if the plans hold up.
Okay, the roadmap looks clean on paper. I'll give them that. Step 1, get the cash from the Novo deal. Check. Step 2, for the YARTEMLEA program to cover its own costs by 2026. That's an aggressive target. Step 3, for the entire company, including all their other R&D, to be cash flow positive by 2027. You know, it's a solid-looking blueprint, but a blueprint is just a piece of paper. What do the pros think? Are the architects on Wall Street buying this plan, or do they see some fundamental flaws in the design?
Well, it turns out the professional analysts are overwhelmingly bullish. WB Securities has a $45 price target on the stock. H.C. Wainwright is sitting at $40. D. Boral Capital at $36. The median price target is a strong $40 a share. Now, considering the stock was trading around $10 after the announcement, Wall Street is basically projecting a potential 300% upside from here. This isn't just mild optimism, it is a massive vote of confidence that management can execute this blueprint and that the YARTEMLEA launch is going to be a blockbuster. You know what? I don't care how bullish Wall Street gets. Every structure, no matter how strong it looks from the outside, needs a thorough inspection before you put your money into it. We need to find the hairline fractures, the hidden weaknesses that could cause the whole thing to crumble under pressure. A high price target means nothing if the underlying fundamentals are weak. So what does the balance sheet really say? Where are the potential cracks in this foundation?
You are absolutely right. A good analyst weighs the risks with equal, if not more, attention than the potential reward. And there are several significant risks here to monitor. First, they've got these complex financial instruments on their books called convertible notes, and those can cause huge non-cash swings in their reported earnings based on the stock price. Second, as we talked about, operating expenses are going to have to ramp up significantly to fund this launch. Third, and this is the big one, is pure execution risk. Can this management team, which has never launched a drug of this magnitude, actually pull it off? We've also seen some insider selling, about 60,000 shares sold recently. And finally, you always have potential regulatory hurdles down the road. But here's a number that gives me serious pause: 1. That is Omeros Piotrowski F-score. Now, for those of you who don't know, this is a simple 9-point checklist that was developed at Stanford to measure a company's fundamental financial strength. A score of 8 or 9 is considered rock solid. A score of 0, 1, or 2 is considered extremely weak. A score of 1 is a huge red flag that points to poor underlying business operations. It's a bright red warning light flashing on the dashboard. This is exactly what I was talking about. These are major cracks in the armor. That massive one-time profit from the Novo deal is basically papering over some serious underlying financial weakness. A Piotrowski score of 1 is a huge concern. And the GF score of 38, which is another one of these aggregate financial health metrics, also suggests the company is in potential distress. This tells me that while they have a lot of cash in the bank right now, the core operational engine of the company is sputtering badly. And then you have the valuation. The forward price-to-earnings ratio is an astronomical 418. Now, to put that into perspective for you, a PE ratio of 20 is often considered fair value for a stable company. 418 means the market is pricing in a truly unbelievable amount of future success. The bar for them is set incredibly high. Omeros doesn't just need a successful launch for YARTEMLEA. They need a flawless, home run, grand slam launch just to justify the current stock price, let alone have a shot at reaching those $40 analyst targets. So this is the crux of it all. It's a classic battle between two very powerful narratives. The bull case is that Omeros has de-risked its future. They have a war chest of cash, they've paid down debt, and they have a newly approved drug with zero competition. It's a clear runway ahead. But the bear case is just as compelling. They have zero operational revenue. They face massive execution risk on a drug launch that has to be perfect. They have these troubling financial health scores hiding just beneath that one-time profit. And they have a valuation that leaves absolutely no room for error. This is the ultimate biotech story, a company rich with cash and potential facing the monumental challenge of building a real business from the ground up. So here's the bottom line. Omeros executed a brilliant financial maneuver, bringing in $240 million to pour a brand new foundation for the company. The question you, as an investor, have to answer is whether that foundation is solid enough to support the skyscraper they intend to build on top of it. Will the YARTEMLEA launch become a powerful engine of growth that builds a profitable, self-sustaining future? Or will the execution risk, the concerning financial metrics, and that sky-high valuation prove to be the hidden cracks that eventually cause the entire structure to crumble? That's the billion-dollar question. Thanks for tuning in to Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.